Welcome to our web edition of What's the Big Idea? My name is Mike Curran. I'm one of the partners here at Cush Capital. Normally you see one of my other partners, Vern Cushenberry, doing these webcasts, but we wanted to throw a little bit different face. Unfortunately, it's mine. But anyway, we thank you for joining us today. And the What's the Big Idea events that we hold every month here at Cush Capital are really for our friends and clients, but really they're open to anyone who wants to come and find out a little bit more about Cush Capital. Maybe they want to come and find out what's going on in the economy. They want to hear our big idea for the month. And so we really use it as a place to, some people come to network, some kind of find out about Cush Capital, and then there are those that want to come and find out, take that big idea and go home and put it in their portfolio. And that's fine, and we're cognizant of that, and so we want to make sure that we've got something that's priced right, that if they did go home and do that, that they would be okay doing it themselves. And so this month's idea is something that we've owned before. We're kind of excited about it. It's a larger name, it's a larger company with a brand name that most people have heard of, and that is Intel. And so we're really glad to talk about Intel today. If you don't know who Intel is as a company, probably every 3 out of 4 computers in the world has Intel inside of it. And Intel is basically a microprocessor company. They have the brains inside the computer and inside servers, all those things that hold all that storage and data that we have from the internet. That's all Intel. And so this is a big name. You're probably maybe even watching this webcast on a computer that's got Intel inside of it. As I talk about these, if you've been with us before, we use a slide deck of really kind of a culmination of all the research, all the things that we watch on a daily, weekly, and monthly basis. And so you'll see those slides pop up as I talk about them as we go forward. So I may or may not have the number right, hopefully, but hopefully you can see that. You can also go to our website, download the slides, and see them yourself if you want. And we'd love you to do that. So if you want to, so feel free to join along with us as we do that. And really, when we first start out, we show our first slide, and that's on slide 2, and we talk a little bit about Cush Capital. Invariably, we have people come to our meetings that want to find out a little bit more. They all prospects. They've heard about Cush Capital, and they want to find out a little bit more. So we start real quickly with a slide, just a little bit about us. We're a registered investment advisory firm in Overland Park, Kansas, and we pride ourselves on better research. We're really nerds at heart. We love to read, love to dig into companies and industries, and companies specifically. We like to dig into the SEC filings. We're listening to the quarterly earnings reports. We're talking to the management teams, and so we're really getting nitty-gritty, knowing these companies backwards and forwards. And then we have a basis called the 3 M's, which I'll talk about in a little bit. It's kind of the basic framework for, hey, is this company somebody that we want to invest in? And so we really try to pride ourselves on better research. We follow golden rule investing, which is really important for us here at Cush Capital because it means that we're fully invested alongside of our clients. And I pause to let people absorb that, because that is something that we, again, think that sets Cush Capital apart. It's really something that we think that allows us to proceed with integrity, and it's being right there with our clients. So if something's good enough for my clients, then it's good enough for me. And so our riskiest portfolio, which is fairly conservative, is what the partners are in, and then we get more conservative from that point on. So we think that's a really important point, and one that sets us apart. We're really conservative. We're deep value and value investors, and so kind of the Warren Buffett rule of investing is, the first rule of investing is not to lose money, and the second rule is to not forget lesson 1 or rule 1. So we try to live by that. We are a biblically responsible investment company, and we are a certified Catholic practitioner. Now that certainly does not mean that we're the moral authority on anything, but what we try to do is we try to incorporate what we do on Sundays at church into our daily lives, and this is our kind of our way of doing that. And then we like to do business with like-minded investors. We like people that can engage us in a conversation about the economy or about an industry or about the stocks within our portfolios, because we love to tell stories and we love to talk about the research that we've done for certain companies, for all of our companies. But we love to have that conversation, because as we can dialogue with our clients, we gain their trust, they learn more about our process, and usually they tell us that it's a little bit different than what they've had in the past, because their broker or even themselves, they really didn't know much about the company that they were investing in. And so we're able to bring that to the table, so we like that. So anyway, enough about Cush Capital. Let's get to our first slide, which is slide 3. And this is a slide that shows the U.S. debt outstanding by sector. And this is going to include your federal debt, your local, your state, all the government debt. This is our household, our mortgage, municipalities, all business debt. So basically all the aggregated debt that we have in the United States. And the notional value of this aggregate is over $60 trillion. Now this chart's a little bit outdated, and we update this internally, and it doesn't look as nice on a presentation, so we do show the old slide. But we do show this slide every month because, you know, actually this $60 trillion does not even include entitlements. And so if you include entitlements like Social Security and Medicare, we're up over $100 trillion. Now that is a mind-boggling number, a number that's hard to even wrap your head around. You just like, I don't even understand that kind of number. So, but really debt and what's going on in this slide is really what drives us in terms of how we position our clients' portfolios. More than anything else that's out there, negativity in Europe or just anything else, is debt. There's so much debt out there. So to put those numbers in context, we show you the next slide, slide 4. And this is really the current trajectory of this U.S. debt. You know, as we continue to spend $3 for every $2 that we take in, we're going to move from our current right about 100% of GDP, debt to GDP right now. And this, as this chart shows you, we're looking at in 2035 almost doubling where we are now, which is, again, is scary, at 185%. So this will take us on a trajectory past the worst offenders that you're hearing out in the news today, Greece and Italy and even Japan. And so that's obviously not a good place to be. If you think about this, this is kind of a preview. What's going on in Europe right now is kind of a preview for what could be happening in the U.S. if we don't change or correct course. And our working thesis is that this can't happen, this won't happen. We're not doomsdayers, and so we're going to have to make some difficult decisions going forward if we are going to change course. And that's going to include some of the following. It's probably going to include some increased taxes, which you're seeing come our way pretty soon. You're going to need to see some decrease in spending, especially entitlements, and thirdly, basically, is you're going to have to pay off these debts with dollars of lesser and lesser value. So as the Fed continues to print money, you're going to the value of this is going to be eaten away by inflation, and so we're really positioning our clients' portfolios ahead of that, which we see coming. On slide 5, if we switch over to that, and we hear a lot in the news about how the unemployment rate is dipping down. We almost touched 10%, and if you hear the shadow statistics out there, we were actually a lot higher than that. But you see that number creeping down, down, down. The economy's getting a little bit better. It's been very slow. But something we look at really closely versus that unemployment number is the average hourly earnings. And as you can see from this chart, we're down at a level as low or lower than we were in the mid-1980s. And So that person that went out and they had a $100,000 IT job and they were unemployed for a year, they got laid off at their company in that 2008, 2009 area, maybe even in the last couple of years. They now go out, they're on unemployment, their unemployment starts to run out, they finally find a job, and who knows what that job could be, whether it was in the IT business or not, but it's probably coming back at what we're finding is a lot less of a salary. And so that average hourly earnings wage has been going down and down and down. And so that's something that we watch closely and worries us. Our next slide, on slide 6, this is an interesting slide. This is actually a number that we watch every month, but we hadn't seen it actually aggregated in a chart for us. And so this is another, I used that word mind-boggling earlier. This is another mind-boggling statistic that right now, as of December 2011, over 46 million people are on food stamps. I thought the U.S. had a population of about 300 million people, so you're talking about well over 10% of our population is on food stamps. And most of that run up, as you can see from that chart, is from 2008. So again, not good. So I've talked about some negative things, and we really make an effort here at Cush Capital to kind of lighten things up as we go along, because we really have to. It helps us stay sane, to be honest with you. And we found a good chart. So we try to look for pictures and funny things as we're going along, and this is one that we picked up this month. This is a guy doing a presentation, kind of like I'm doing here, and he says, here's a chart that shows what you might see if you looked at a mountain range through a tennis racket. That really made us laugh, because that's our stock market, to be honest with you. It's just up and down, up and down, so sometimes we feel like we are giving this presentation. The next one is from a gentleman called Douglas Adams from the Hitchhiker's Guide to the Galaxy. Don't ask why we found that. But a common mistake that people make when trying to design something completely foolproof is to underestimate the ingenuity of complete fools. We agree with that. The last slide I have on charts before we get to Intel is a slide. It's slide 9, and it's the unemployment rate for the under 25 in Spain. And it is a number, when I saw this, and I've seen this just shoot up lately, is incredible. But the unemployment rate for the under 25 in Spain is over 50%. Again, this worries us, because if you've got a lot of young people, that's when you really start, and you're just out of college, you're trying to get a job, and they can't find a job. 50% of those kids can't find a job, so they're getting a later start in their life in terms of their financial life, and that's volatile. So you're out there, you tend to be somebody that maybe is going to go protest and rebel against the government and things like that. So that's something that we're watching really closely over in Spain as their debts continue to increase and need bailing out. So I talked about the framework earlier, and if we go to the next slide, slide 10, we start to talk about the framework of, and looking at the context of the companies that we invest in, or at least start to do the research on, is the 3 M's. And the 3 M's stand for management, moat, and mispricing. We wrote about this in our April 2012 newsletter, so you can go to our website and pick up that if you haven't had a chance to read that. It'll give you a little bit more in depth. But real quickly, as we go forward in this business, the more years that we're into this, we figure out that the management team is the most important thing in investing in a company. They've got to have demonstrated a high degree of honesty and integrity and being shareholder friendly. And there's a lot of different ways to evaluate that. But we constantly, as we're listening to those earnings calls or watching any video that's out on there on the executive teams, you get to learn a lot more about how those people really operate. And so that has become more and more important to us. The second one is a medieval term, a moat. Obviously, digging a moat around a castle kept intruders away, kept the enemies away. And that's the same kind of concept, is that, you know, if you have $1 billion and there's a company out there that's doing really well, can I go recreate that company? Well, we want something that has a moat around it, that is hard for others to come into that business, whether it be patent protection or technology advancements or the myriad of reasons. And then we say that all three of these 3Ms have to be there, and especially mispricing. So you can have the first two, but if you buy that stock at a completely wrong time where it was overvalued, that you can really do some detriment to your client's portfolio. So we have to have all three. So if we get into Intel, we're going to do this fairly quickly because I wrote a research report that you can access out on the web, or you can contact us and we can get you a copy of that. Go into 11 pages of debt, obviously, or 11 pages of talking about Intel. And so just go over real quickly some of the things that we like about Intel. If you look at slide 12, we talk about the market share that they have, just to get you an idea of who Intel is. So in the desktop, those desktops that we still, most of us have anyway at our offices, they own about 3/4 of those in the world, right at about 75%. Actually, that number is a little bit higher than that, but they talk about 80 to 82% of the overall computer market. But desktops about 75%, the mobile, which is the laptops here, about 84%. PC servers and workstations, those servers, all that stuff that collects and holds all that data, they have about a 95% market share of that. So that's amazing. Smartphone and tablets, obviously that's in the last couple of years, that's been the growing, and they have less than 5% market share in that. If we flip over to slide 13, just real quickly, because I don't obviously want to get into the numbers, well, we showed this slide because we talk about a company that maybe goes through what happened in 2008, 2009, and IT spending really dropped, and corporations really, everything kind of froze up, and Intel was hurt a little bit by that. They obviously didn't make the money that they used to, but as you can see from this chart, in 2009, again 2010, and 2011, their revenues grew amazingly. And this is a company, and I don't have it totaled on here for you, but that did $54 billion in 2011 in revenue. And so, as you can see also, their PC business, their PC client group there, is growing. And we'll talk about that in just a minute. If you flip over to chart 14, just to give you a real quick recap of kind of the drivers, what we like about Intel going forward, is we really feel like they're well positioned for the future. That less than 5% market share on smartphones and tablets is something that we think is going to change. They're a leader in the processors for PCs and servers, and so being the leader, having the market share that they do, obviously gives them a lot of revenue that they can turn around and invest in capital expenditures and their research and development, which is crucial to this story going forward, that they continue to maintain that. So they're reinventing the PC with the Ultrabook. The Ultrabook's kind of a new term here in the last probably 6 to 12 months. If you haven't heard of it, an Ultrabook is kind of a hybrid between the laptop and the tablet, maybe the iPad or the Galaxy tablet. There's some new tablets coming out from some different companies. So this is kind of a hybrid between the two. It's a little bit larger screen, very thin, metal casing, and sold by a lot of companies, IBM, Lenovo, HP, Dell. Everybody has an Ultrabook now. The nice thing about it, almost 100% of the insides of all those Ultrabooks have Intel inside of them. Paul Otellini, the CEO of Intel, made an interesting statement as I was reading through a lot of the due diligence, is that he said that over 40% of the Ultrabooks, 40% of the PCs shipped in the United States in 2012, this year, are going to be Ultrabooks. And that was kind of an amazing thing because I hadn't really heard of Ultrabooks. And I've asked a lot of people, and not a lot of people have heard of that. So they're going to have to do some amazing advertising for that. Intel's going to capitalize on the data center and the internet growth. And as we use our phones, as we do more and more things with the internet and saving and video and graphics and everything, we're going to need more and more servers to hold all this stuff. And so Intel's poised great for that. And they're going to bring the best of their Intel technologies, which they've done so well with their PCs and servers, over to the smartphone and tablet market, and they've got a lot of products and a lot of products in the pipeline to help do that too, and we think they're going to be able to do that. We've been big believers for a long time and trying to figure out how to invest in security on the web, security on your phones, your tablets, everything else. More and more malware, spyware, all that is causing problems for the internet market. Having a computer, getting hacker to crashing your computer, all that. So we think that's going to become more and more important. And Intel last year bought a company called McAfee. And if you buy a new computer, you usually either have McAfee or Norton that comes up and says, hey, do you want to subscribe? Buy this package for a year. So we like that. They're investing a lot of money in that business, and we like that going forward also. You know, emerging markets continues to be a big driver for them. Their PC sales in emerging markets were up over 18% last year. And so people are still buying computers, and they're buying them even more in emerging markets, and we like that. And then they have a widening process technology and manufacturing lead. They've got about a 4-year lead over their nearest competitor, who is Advanced Micro Devices, in terms of the technology that they have for their chips. So we like that. As they're putting more and more money into that R&D, they're widening their lead against their competition, and that's a good thing. If you flip over to chart 15, we'll talk quickly about the first M, and it's the management team. There isn't a ton to say here because the CEO, Paul Otellini, has been with Intel since 1974. He's had a lot of different jobs within Intel, and has been the CEO since 2006. Before him was a gentleman named Andy Bryant, who's still with the company, in fact, is the chairman of the board. And if you look at the top executive team with Intel, you're going to find people that go back into the 80s, into the 70s with the company. They've been around a long time. That is not always a good thing, but as you can see from what Intel's done over the years and the revenues they've produced, that the management team is solid. Top executives are vested at Intel. Now, obviously, with a company that big, the percentages are a lot smaller than we're normally used to talking about that. I think the last time, about 3 months ago, when I talked about Sprott Resources, Eric Sprott had about 8% to 10% ownership in his company. Now, obviously, a company as big as Intel, you're not going to have those kind of percentages, but we're comfortable with the fact that the top executives are vested in Intel. They have a vested interest in seeing the company do very well. So we love investment company or management teams that are shareholder friendly, and this has definitely been one. They've increased their dividends every year over the last decade. Now, for a company to pay a dividend is a good thing. It means they have confidence in the business they're doing. If they increase that dividend, that's even more confidence. And then if you look at the bottom point on there, they've actually increased their dividends 3 times in the last 18 months. We like to see that. Definitely, and if you aggregate all the dividends and buybacks that they've done over the years since Intel started, they've returned over $112 billion to investors. So we obviously love that kind of track record. If you flip over to chart 16, we're going to talk about the moat with Intel. They have low threats to new entrants. It's hard to start up this type of business. Most of these companies, the competitors have been around, have been with Intel, or been in that business for 30 years or more. The technology is advancing so quickly. You could ramp up a company to do a certain thing, and that certain thing could be could be obsolete, or you could be behind the track already. So again, just very hard to start. They've got an ecosystem of software vendors, people that are buying their products to put into new computers that come out. And so they've already got that ecosystem, those relationships all developed. You know, you can look at their personnel. They've got over 100,000 employees, and about 1/3 of them are engineers to continue to allow them to innovate. And so we like that. And then Intel is mispriced, we believe, for a couple different reasons. I've talked about a couple of the things before, but earlier in this, but they're really tied to the negative headlines of the declining U.S. PC market. And I talked about Intel their products are growing within the PC business, but if you look at the overall PC business, it is starting to slow down, although it's not negative. It's still growing, but growing slower. And so there's that perception that this market's going away, everything's going to smartphones and tablets, and that Intel's going to be hurt by that. And so they are going to be hurt by that if they can't get into some of these newer areas and continue to be as strong as they are in those areas that they are on. So that is something that's caused their stock to come down quite a bit lately, as they've been tied to that supposed declining PC market. And really the other one, the main one, is the question whether they can transition into getting into those smartphones and smartphone and tablets in a big way. So we're obviously going to be watching that. So you look at the valuation of Intel, and this is a company that's trading for less than 10 times its earnings. And that is, from a value investing standpoint, is the threshold and is considered where the stock's considered cheap. It's got a strong dividend yield. It's paying over 3.3%. So let's say that we were wrong and Intel's not going to grow and the stock's going to pretty much stay flat where it is over the next few years. We're going to clip off a 3.3% dividend while we wait for them to grow. We don't think that's going to happen, but if the worst case scenario, if that did happen, then we're getting paid twice what a 10-year treasury is paying. So we're okay with that in terms of where we're using that within our portfolios. And then the revenue growth of 7% while they maintain their current margins gives us a price target of 35. And so with the stock trading around 26 today, that's a nice premium. So they do have some upside. They're giving you a good dividend, and we like that. Quickly flip over to slide 18 and talk about the risks there are with Intel. And I've talked about a few of these. We've got to continue to innovate. They have to continue to bring out new, better, faster products. We just demand that as a society. The U.S. market, PC market, is in a decline in terms of the growth, so that's a risk. There are two main competitors, Advanced Micro Devices, AMD, and ARM Holdings. ARM has about 95% of the market share in a smartphone. So if you pick your smartphone out of your pocket, it's probably got ARM holding chips within it. And so they're very formidable competitors, and they could put up a good fight against Intel. So that is a risk. Inside those chips that they build is a lot of commodities, silicone, other things that could spike up in prices and squeeze their margins and have them make less money. Parts shortages. Last year we had a tsunami in Japan that caused a lot of havoc within the technology industry. And so we could have something like that. Legal and patent challenges. These companies are all suing each other over, hey, your product looks exactly like ours, you're using a similar software, all this kind of thing. So Intel doesn't have any eye-popping legal challenges right now at all, and so we feel okay about that. But that is a risk down the road, and then their new products won't be easily adapted. So maybe they come out with something we think's cool, but it just doesn't go anywhere. Somebody else comes out with something similar or whatever. So there's that risk. So if we recap real quick, and first of all, if you've made it this far on this in this webcast, I really appreciate you hanging with us, and hope you'll join us again. So real quick to recap Intel, we've got a world-class blue chip company. We've got the largest semiconductor company in the world, selling for less than 10 times earnings. Pays us a 3.3% dividend. It's got $14 billion in cash and a very low debt load. And the amount of money they're putting into their capital expenditures and their R&D is really setting them up nicely to capture that market share in that phone and smartphone and tablet market. And they clearly pass as one company that's not even a question, but they truly clearly pass our 3M test. So our very last slide, and it's on page or slide 20, is we always ask our people, we call it a call to action. So if you like what you've heard, if you would like to hear more, you can call us, get a hold of us, make an appointment with us. And that could be on the phone. We do have a lot of out-of-town clients, and so we have a lot of people that we're just dealing with on the phone. And so please do make an appointment with us. find out more about Cush. Help us spread the word if you do like what you've heard today. Again, just we're doing something different here at Cush, we think. If you are local and you'd like to save the date for our next breakfast meeting, What's the Big Idea event, is going to be here in a couple weeks on Wednesday, July 11th at 7:30 in the morning. And then we also host an investors club every day where I'm sorry, every day. Jeez. Well, we do kind of, but it's actually once a month on the fourth Monday of every month at 5:30. We have a group of individuals that get together and talk about the nitty-gritty of a certain company. We really dig into it, and it's just hosted by us. We have a lot of great people that join us for that, so please do. And thank you very much. I appreciate it. Have a good night.